Hi, everybody. This is David Skrika. This is actually, it's interesting because of recent events. Sorry for not having a stock chart on Tuesday. We always I'll make up for that by having one on the weekend. Um, so excuse me. Yeah, we're looking here at um, national debts the next couple of days. Actually, we're going to look at bond markets and national debts. I know it's stock chart of the day, but these things are important to investing and the whatnot, even though they've been, ignored for many years. So we're going to take a look at this right now. So I'm going to do it in two things. The first thing I'm going to show is, because I'm doing this because obviously the U.S. just got downgraded, and we're gonna show you um, the problem with that going forward. So this is, of course, the U.S. debt clock. It's a pretty famous site. They have, one in Times Square. Um, you know, in New York, and you can see we're over 32 trillion. We're at 123% of GDP. It was 56% back in 2000, 34% in 1980, and 52% in 1960. So the highest since World War II, when those big budget deficits run up to fight the war. So total debt to GDP is 130%. That includes 36%. That includes the states and the municipalities. A lot of countries are like that. Like Canada has a lower federal debt, but because the Canadian provinces are a little bigger in terms of the size of their governments, they have more provincial debt. So I think the Canadian debt situation, again, municipal, provincial, and federal, is like 120, 130%, not much below it. And spending to GDP ratio is 38%. Of course, some of this is now owned by the Fed because of all the quantitative easing. So some of that interest is going right back into the Treasury, but it just shows you how we are. And the issue with it going forward is, with basically almost 3 trillion in Social Security and Medicare, and then another, as you'll see, 900 million or billion, but in going to a trillion in interest payments. We got roughly 4 trillion of the debt, sorry, of the budget, and things that really can't be cut. Obviously, interest cannot be cut unless you start, having less debt, and no one's going to go for cuts to Medicaid, Medicare, or Social Security, and defense is very difficult to cut as well. So, and then there's all these other things here. You can see, that student loan debt is another 1.8 trillion, credit card debt's an 1.3 trillion. So you can just see, until it's not a problem until it is. And with low interest rates, no one was worried about it. Here's the chart of the total debt, which you can see, was 1, 2, 3 trillion for years, then really began to exponentially go higher after the financial crisis. It started to increase its pace during the 2000s after the dot-com bust, and then really has gone crazy since the financial crisis. And then you can see the huge jump during COVID there. So and again, no one really cared until it mattered. So now we're going to look at this graphic. This is really the chart of the day. Right here, you can see this is the annualized interest payments of the federal government. You can see really from 1990 to 2016, it didn't really go up much. Like it went from like 300 billion to just 400 billion, only up 100 billion a year, because interest rates kept going lower, even though, from 1990 to 2016, the federal debt went higher. So then the explosion in debt in the, under Trump, and rates went up a little bit, causes increase from about 400 billion, to 600 billion. And then we went back down to 500 billion, even though debt again increased because rates again went lower in 2019 and 2020. But now we've exploded to over 900 billion. We're probably close to a trillion now. So really, if we look at it this way, we're up nearly 500 billion. That's about 2% of GDP, just in interest payments. So that's 500 billion. Like, you see the defense budget is 800 billion. That's 60% roughly of the defense budget. And you can see that since, the we've gone from 350, we've almost tripled in interest payments since the end of the financial crisis. So that really shows you. And the problem is, and then that means the government will have less money for Social Security, for Medicaid, for Medicare, for defense, before these things that we all take for granted. So that's the real problem with it. It comes back to Fitch downgrading it, because once you get downgraded, your interest payments will at some point begin to be higher, because a downgrade means there's more perceived risk. Like junk bond companies have to pay a lot more interest than investment grade companies. So that's what we're talking about here today. And I do think at some point this will matter. And also, this is why I think the Fed in the short term, the long term, this can mean higher interest rates. In the short term, they're almost done, because you can't have these interest payments go to 1.5, 2 trillion, $2 trillion. So, and I think they know that. So this is why I think that maybe if they do that November rate hike, that's going to be about it. Now, let's see how the market reacts to, there was a sell-off back in 2011 when there was a downgrade back then. So, but like this is unless, that was the first ever downgrade of US debt from, AAA. So this is not quite that same effect. And look at countries like Italy have been, and numerous others have been downgraded over decades now. And actually, they haven't fallen apart, and their interest actually has gone down. So it doesn't necessarily have to have that effect. And, AA plus is basically the second highest rated, and many, solid countries have that. So, but I just wanted to show you the issues with debt, interest, etc. And we're going to show you the most indebted country in the world in our next stock chart of the day, which will be out tomorrow on Thursday.